If you just glance at the headlines, the global economy looks, well, surprisingly strong. But the OECD is waving a big red flag, warning that things are actually getting pretty fragile underneath. So, what's the real story? Are we cruising towards a solid recovery, or is the whole thing a lot more wobbly than it looks? Let's get into it. So, the OECD came up with this really great metaphor to explain what's going on. Picture an ice skater, right? They're moving fast, gliding smoothly across the ice, but that ice is getting thinner and thinner. The speed is great, it looks impressive, but the risk of a sudden crack is, well, it's very real. It's a perfect way to picture this tension between looking strong on the surface and being super fragile underneath. And that really is the big question here, isn't it? Are we gliding our way to a real, lasting recovery? Or are we about to hit a massive crack in the ice? Let's see what the numbers have to say. All right, so first, let's talk about the good stuff. Why does everything seem so okay? Because honestly, the global economy has been way more resilient than a lot of folks predicted. I mean, with all the uncertainty out there, growth has held up surprisingly well. So what's the secret sauce? What's been propping everything up? Well, a huge part of the answer is tech. We're talking about a massive wave of investment pouring into things like AI and IT. This tech boom has basically been the engine for the whole economy, shielding it from other problems and really driving demand. And you can see just how big a deal this is right here. This chart really tells the story. Take a look at the huge boost that information and communication technology, or ICT, is giving to GDP growth, especially in the US. It's just blowing other advanced economies out of the water. This American tech surge is really the main reason the global outlook seems so bright at the moment. Okay, but that's just what you see on the surface. Now we have to look underneath. Because as we dig into the OECD report, it starts to point out some pretty serious cracks that are forming. All that speed is putting a lot of pressure on the ice. And this brings up a really important question, right? If the tech sector is booming and everything looks so resilient, why is the OECD sounding the alarm? Why are they so worried? Well, it's because there are some big risks bubbling up just out of sight. In fact, the OECD pinpoints 4 major risks. These are the really thin spots in the ice we need to watch out for. Let's go through them one by one. All right, risk number 1, rising trade tensions. We're seeing more and more trade barriers pop up, and a lot of uncertainty about what comes next. All these new tariffs, and even just the threat of new tariffs, that stuff starts to show up as higher prices for everyone. And that, of course, could really put the brakes on everything from how much we spend to how much businesses are willing to invest. And this isn't some simple single trade war. It's way more complicated than that. Just look at this table. It's a total patchwork of different tariffs. You can see these huge differences in the actual tariff rates for stuff coming into the US. Rates on imports from China have come down, but then you've got the EU, Japan, Canada, Mexico, all facing different rules. All this complexity just creates a ton of uncertainty and really messes with global supply chains. Okay, on to risk number 2. And this one's a little sneaky. It's hiding in a part of the financial system that has absolutely exploded since the 2008 crisis. The catch? It operates with way less oversight than your typical bank. And the sheer scale of this is, well, it's kind of staggering. Just look at this chart. It shows the incredible growth of something called non-bank financial institutions, NBFIs for short. Get this. They now hold almost half of all financial assets in the world. So what in the world are they? Okay, let's break it down. Basically, NBFIs are companies that do bank-like things, lending money, making investments, but they don't have to follow the same strict rules as actual banks. Think of private credit funds, hedge funds, that sort of thing. The problem is they've grown so fast and they're so interconnected with the regular banking system that they're creating these new kinds of risks that are really hard to spot. Risk number 3, and this one brings us full circle, right back to that engine of growth we talked about, AI and tech. And the big question here is, has all the hype, all the massive optimism, created a dangerous bubble? Whoa, this slide really tells you everything you need to know. We're looking at the price to earnings ratio. It's just a simple way of measuring how much investors are willing to pay for a company's profits. And right now, it's skyrocketing, getting dangerously close to the levels we saw right before the dot-com bubble burst. That's a huge red flag. It means the market is expecting absolute perfection, and if there's even a tiny bit of bad news, it could trigger a massive sell-off. And believe me, the OECD is not pulling any punches here. They say it flat out. These super high valuations pose a risk of potentially abrupt price corrections. In other words, a crash. And a crash like that could cause some serious problems, especially in that shadowy non-bank financial sector we were just talking about. And that brings us to the fourth and final big risk. Governments themselves are feeling the squeeze. Public debt is high, and in many places, it's still rising. That really ties their hands and limits their ability to step in and help if another crisis hits. To put it simply, a lot of governments are basically running low on cash. So let's recap. We've got trade tensions, a huge shadow banking system, a potential tech bubble, and governments that are strapped for cash. Yikes. The situation looks precarious, to say the least. But it's not all doom and gloom. The OECD report doesn't just list the dangers, it actually gives us a roadmap to get to safer ground. So let's check out the plan. Okay, so the OECD has this 5-step playbook for policymakers. It's pretty straightforward. Step 1, cool down the trade tensions. We need more predictability. Step 2, central banks have got to stay laser-focused on getting inflation under control. Step 3, regulators need to get a much better grip on that whole non-bank financial world. Step 4, governments have to get serious about their debt. And finally, Step 5, countries need to push for big, ambitious reforms that can create real sustainable growth for the future. So there you have it. The map to get off the thin ice and onto solid ground is actually pretty clear. The risks are out in the open, and the solutions are right there on the table. The real question, the big unknown, is whether policymakers around the world can actually work together and find the political will to follow it.